All right. I'm with a new guest here on Goldfinger Capital. His name is Garrett Goggin. I recently met him at a mining conference, a precious metals conference in Canada. But we actually both live in Florida. Garrett, it's great to have you here on Goldfinger Capital.
Hey, Robert. Cool. Thanks for having me. Looking forward to talking to you.
Yeah. Your X feed, I believe, has gotten a lot of attention here in 2025. Obviously, the gold price trends help that get more attention and more engagement. But I think you've been making some very valuable points. You've been giving out a lot of data, really good information for free on your X timeline. And I want to talk a little bit about that. But first, let's just talk about how you got into the gold mining sector and sort of what you're focused on.
I grew up in Boston and worked in the traditional financial sector. I worked for a mutual fund company up there, right? Where, invest for the long term, keep buying the dips, everything will be okay. Keep buying the S&P. And then, I was always that, mindset. I'm like, what if it's not okay? What if, the dollar can loses value, inflation goes through the roof, and, the world's reserve currency, has a certain lifespan. And what if we reach the end of it? And, I don't know. I'm a CFA, chartered financial analyst. I'm a CMT, so I do the technicals. But I believe in more probability-based technicals versus just squiggly lines on a chart. You know what I mean? But I do deep dive research and try to really value these equities, and that's what my product is all about, the golden portfolio. And right now it's things are starting to come together, right? Where it's a unique period, and gold's doing well. There's not a lot of bank analysts that even cover the sector anymore. And my golden portfolio product does true deep dive fundamental analysis on, the best investments in the gold and silver sector.
So when did you make the transition from more of a generalist, investor and analyst to being more focused on the gold sector?
Well, I went back, I got my MBA in like 2009, and then I reached out to some, people that I followed that I admired their work. And I reached out to John Doody at Gold Stock Analyst, and, John is, legend in the industry, and it was the right time and the right place. He said, yeah, come on board. I need some help. And, I started working with John in 2010. So I've been doing this for 15 years. But it's funny because, John's been doing it since, the 90s. He was doing it on the island of Nantucket. He was sending everything out by mail, not even email. Like, he was printing stuff. And then when I first joined him, I'm right at MBA, CFA. He's like, you're not going to use those spreadsheet things. You're going to use an adding machine. And he dropped an adding machine on my desk. I was like, this isn't going to work. But it did. And, with the golden portfolio, I'm able to, bring all my new techniques, and apply them to the mining sector and kind of, build a good product.
Okay. Yeah. Yeah. I want to talk more about your golden portfolio in a bit, but first let's talk about gold mining sector profitability. So like if we think back maybe since the 70s, probably since where we have some good data to start with, and that bull market phase and the cyclical bull markets of the last 50 years, how does this gold bull market and gold miner bull market stack up, in comparison to the other bull markets of the last 50 years?
Yeah, well, this time's different, right? And
Okay.
I hate saying that, right? Because this time is different. You're wrong, but that means it's a market top. Everyone thinks that, and market tops out, then it goes down. But based on the probability and statistics and the numbers, this time is different because previous sell-offs, every major market sell-off in 2000, 2008, we had one in 2020. What happened was, the stock market went down, gold stocks got smoked, gold traded up a little bit, but the dollar rallied and dollar denominated assets rallied. This is the first time in over 25 years where the market sold off, yields have climbed, and the Dixie dropped, and gold stocks have held their own. So, that's why I feel comfortable saying this time's different. And there's many fundamental reasons for it, right? because, our foreign trade partners that we're seeing with the tariffs were pissing them all off. The U.S. has been, pushing their weight around the world for decades, yet they rely on our foreign trade partners to support, the U.S. dollar system by recycling their trade surplus back into treasury bonds. Well, now we're sitting on $37 trillion of debt, mostly financed at the short end. Beset wants to finance at the short end, and we've had yields climbing, although they're dropping a little bit here. But China's buying gold. They're not buying treasuries anymore. Their treasury holdings have dropped like 15-20% over the past 3 years. The number one holder of U.S. Treasury debt, it's the Federal Reserve. The Federal Reserve holds about 40% of it. Everyone looks at foreign holders, China, Japan. The Caymans has popped up. The Caymans is a quasi-government, hedge fund. They're the largest increase in treasuries. So what this leads to is that, Trump has said they need low yields. They need a lower dollar. So the way they're trying to manage it is hard because they're losing support from their foreign trade partners who are buying gold instead. And what I see happening, I think Beset has a press conference today at some point, but we're going to see the Fed be wrapped in closer with the Treasury, and the Fed's going to be buying Treasury debt. Like it's true, money devaluation. Like that's what we're getting to right now. That's the only thing that can support, our treasury bonds with lower yields. And then what happens with that is, we're going to see monetary devaluation. The stock market could go to whatever, 100,000, but a bottle of Coke's going to cost $20, Like we're in that true endpoint of world's reserve currency, where nobody wants it.
Yeah, I never thought I'd live to see the day where a U.S. president is intentionally talking down the dollar, but here we are. So I mean, it's interesting because you started off that by saying this time is different, and then joking that it's never different, and every time that investors say that, they're pretty much always wrong. But this time really is different, and so if we dig in a little deeper into that and what that means for gold mining stocks, how is it different this time in terms of free cash flow and profitability?
Well, all this stuff leads together, but one of the reasons why I feel comfortable saying this time's different, which means this is not the peak gold price. Like, yeah, gold may trade down. It's trading down, about $200 from the high a couple days ago. Yeah, we're going to have wiggles in the chart, but gold's got a long way to go. Why do I say this? Because I track asset flows into the sector. If you look at GLD, I look at shares outstanding of ETFs, like the GLD ETF. It's an ETF. So when money comes in, shares are created. The shares outstanding goes up. When investors sell the GLD, the shares outstanding goes down. So you can track true investor flow into the ETFs by tracking GLD and GDX. The GLD shares outstanding is 20% less than its peak in 2011 and its peak in 2020. Like we haven't seen that investor mania where everyone rushes in to create the top yet. You look at GDX shares outstanding. GDX shares outstanding have tanked from 40 million down to like 25 million. They've gone down 30%. Nobody owns gold stocks. So that's why I feel comfortable, because it's supported by the fundamental data and the asset flows into the sector. Is anecdotal stuff. Everyone on Twitter, oh, it's a top, it's a top, it's a top. All the technicians saying, it's over. One of my favorite charts is that one of the ones that I look at the market cap of the S&P versus the market cap of the GLD. At the peak in 2011, there was basically 7 basis points. The GLD was worth 7 basis points of all the money in the S&P. It was a peak. Right now, it's 2 basis points. Gold could go up like 3x higher based on these fundamental, factors that I follow. And then, the mining stocks themselves, right? Like what it comes down to, the value of a mining stock is worth the most on day one of production, right? Because they mine, their reserves drop. It becomes less and less over a 10-year life of mine. Yeah, they can drill and add reserves so it gets extended, but to keep it general, the value of mining equity is worth the most on the first day of production. So on first day of production, the market cap of that equity should equal the lifetime after-tax free cash flow of that mine, right? Because that's what a stock is worth. A stock is the value of the lifetime discounted after-tax free cash flow of any asset, whether it's candy bars or computer chips or miners. And that's why a lot of people don't like miners, because they're worth the most on day one of production, and then it depletes after, right? So it's not a growth sort of asset. But so when you start measuring up the market cap of these companies, what the market values these things at, and the lifetime free cash flow of some of these projects coming online, like for example, Rio 2 is trading for 300 mil market cap. It's got Phoenix that's worth about 1.5 bill. It's going to be in production in 2026. Market cap should equal EV. And then, but it doesn't. It's trading at a 75-80% discount to fair value. And then what we see in market tops, like we saw this, Silvercrest peaked out in 2020. It was a minor gold top. Silvercrest trade for like 2 times NAV. So the asset was worth, say, $1 billion. The stock was trading for $2 billion. We're seeing the opposite of that right now. And that is a measure of investor sentiment as well. Like no one's bidding these things up. I have 5 or 6 examples where you can buy, $3 billion worth of value for 600 mil. And like what I'm saying is that, outside investors, like whether you like gold or whether you're a generalist and you hate gold, it doesn't matter. The only value out there in the market right now is found in the mining sector. This is what the Buffett indicator, right? That it shows the Wilshire market cap of the Wilshire 5000 divided by the GDP of the United States. And it gets overvalued. It got overvalued in 1970. It got overvalued in 2000. It's overvalued now. Both in 1970 and in 2000, gold went on a decade-long run. That's why, I'm leaning towards this time is different. We're in a decade of outperformance. It's a secular shift between overpriced growth and underpriced real assets and commodity assets and gold assets.
So the gold mining sector is one of the true deep value sectors of the stock market still in existence. While most of the stock market has been overvalued or wildly overvalued, bubble type valuations for the last couple of years, the gold mining sector is actually a real deep value sector. If you look at any of the valuation multiples across the sector, whether you go from PE to free cash flow yield, even price to book value, et cetera, the valuations are reasonable. They're not frothy in the slightest bit. And then the point that you continue to make, and you just had a tweet a few days ago, was if at $3,200 or $3,300 gold, these companies are wildly profitable. And there's a tweet that you made on Newmont showing the Newmont share price versus profits per share at $3,300 an ounce. And actually, while we're talking here this morning, gold is actually exactly at $3,300 an ounce. So basically the chart shows, and I'd be interested in you explaining this in a little more detail, the chart shows that Newmont's profits per share, if we assume a $3,300 average gold price, are $12 per share versus a $52 share price. So that sounds pretty attractive to me.
Yeah, well, it's a simple scatter plot, right? That shows the, all-in sustaining profits per share versus the share price. And, you get your regression line up and all the dots are, along that regression line, right? But the period we're in now, over the past quarter, like the Newmont is like the all-in sustaining costs are way down here and the share price is way down here. It should be higher, close to 90. And then the price of oil's dropped tremendously. Oil's the number one cost of production for the mining industry. Like, we're going to see blowout quarters. Yeah, Newmont did a restructuring. You know, they sold about $1 million, 1 million ounces of production, repairing their balance sheet from the destructionary period that happened in like the last peak in 2011. But they raised $2 billion. So, that takes right off EV. So the balance is still there, but it's a true statistical anomaly, like where the gold stocks are trading at now. And again, it ties into like, no one's involved in the sector. No one believes going high. Nobody believes gold going higher. The miners are a bad investment. Like, the money's not there. The investor money's not there. And as investors come into the sector, we're going to see them pushing the price of Newmont higher and the miners higher to a point where you're not able to buy free cash flow at a discount anymore. But the discount right now is the largest for the large miners since 2015 and 2020. And what happened in 2015 and 2020 was the reversal, where the GDX doubled over the next year, was triggered by Fed action. The Fed never cuts when the market's going higher. They only cut when the Fed's going lower. Jerome Powell, they always talk tough, but they always end up cutting. But I believe that that's going to set off the next major run, for the GDX and gold stocks right now. And the ironic thing is, people look at gold, they're like, oh, it's too high. And then they're like, oh, the miners must be too high. But it's the exact opposite. Like, the miners are dirt cheap right now with gold trading at this price. And when the market sold off in 2000 and 2008 and 2020, the gold stocks got hammered, right? So then they traded at a discount. The Fed changed their bias, started QE, GDX ripped. We're at a point right now where we avoided the whole equity sell-off, yet the miners are trading at the deepest discount they have since the crashes of those periods. It's like, I don't think people can get their minds around it, which creates opportunity for us.
Right. It creates an opportunity for those paying attention. I want to discuss this a little bit more in terms of what the disconnect is. So I can think of two main factors that has the gold mining sector still so depressed and out of favor. The first one is that the sector has a history of underperforming and having a bunch of operational challenges. And we see this regularly with some of the big producers like Newmont, like Barrick. In fact, a couple quarters ago, people were really expecting a strong result from Newmont, and they again increased their cost guidance, and their production was a little lighter than forecast. So they got punished. They got punished viciously. The stock dropped from like 58 to 40 in a month. And then the other one is, I think people don't believe the gold price is going to stay here, right? So they're not pricing these stocks for 3,300. They're pricing them for 2,500. And so actually, if the gold price stays, it doesn't even have to go up anymore. It could just stay around 3,000. And I think the gold sector would do just fine, So there's two main things, and Newmont is going to report after the close here today, and I'm just interested in your thoughts on what you expect from this quarter, and are they done with the bad outlooks and the missed quarters?
Yeah. Regarding that, the simplest metric that you can look at is gross profit divided by shares outstanding. That plots like with a 95% correlation to the share price, right? You need to be increasing profits on a per share basis in order to drive the share price higher. That's why Agnico has been a leader of the industry. They've been able to, drive gross profit per share higher consistently over the past decade or so. That leads to that outperformance. The rest of the mining industry has not been able to do that. The reason why Agnico's been able to do that is because, they look at the true all-in sustaining cost, the true all-in cost of a mine, right? you got to pay for the property, right? You got to take over a company that's say 300 mil. You got to build it. That's another 500 mil. So you're already in it for 800 mil. A lot of these miners don't even get back 800 mil free cash flow over the life of the mine. Back at the last cycle peak, I was horrified coming right out of MBA CFA to see these mining companies paying. Ty Burt paid $7.1 billion for a redback. That was like 3 times NAV. They're never going to get their money back, although it's doing well now. So their gross profits on a per share basis like decline. You need to look at like what you pay for an asset and what you're going to get back. And the miners learn their lesson, and they've been paring back their balance sheets for over a decade here. Newmont just finished their last divestiture to raise $2 billion. And right now the miners are gushing cash. The dividends have been increasing across the board. Mag Silver just reported earnings, first quarter production today. They're paying out a dividend equal to like close to a 5% yield. This is silver stock with a 5% yield. And then what companies also do with that extra money is they buy back shares. And I'm seeing share buybacks happen every day because the true scourge of the mining industry is dilution, right? These miners endlessly dilute, and their profits on a per share basis never increase. You look at core mining, you say silver, people are like, oh, core split adjusted was like $200 per share in the late 90s. Now it's at whatever, 4 or 5, 6. Why? Because all they care about is keeping production steady. They don't care about what they pay for it. So their shares outstanding increases, their earnings per share stays level. But you know what? The management gets paid, management and bankers get paid, and shareholders get screwed. So a lot of these mining companies, that's how they've been operating. But now, we're in a different place where they're generating tremendous amounts of free cash. But, you really need to get into the company in order to figure out like what are the investable miners. You get Sean Boyd at Agnico, right? That's focused on driving earnings on a per share basis. You got to get involved with that. You got to stay away from the companies that are just trying to maintain production at shareholder cost by overpaying for, assets and production and profits. Silvercore, this guy Ray Fang is China. And a lot of people are like, silver, China, like, whoa. But I've been covering the dude for like 15 years. All they care about is driving earnings on a per share basis, and the stock has done well. That's the only metric that matters, is driving earnings on a per share basis. You need to find the miners that do that.
So what I hear you saying is that this bear market cycle that the sector has been in for the last decade or so has forced these companies, these management teams, to be more disciplined and to focus more on profitability, per share earnings growth, and not just paying the C-suite and acquiring more mines to have growth at the expense of shareholder value and massive dilution. Is that right?
Yeah, one of the things that has driven me crazy about the sector is you see companies growing from 100,000 ounces of production to 1 million ounces of production, and the market cap has increased from 200 mil to $1 billion or whatever. Yet the share price went down by 67% over that time. And the managements are like, hey, we grew production 10x. Hey, our market cap is 20 times great. It's like your share price went down. Why? Because they overpay for assets. A lot of the major miners, it's like they are, luxury cruise liners or, battleships. They're get going in a direction and it's hard to change course. So, the miners have been focused on repairing their balance sheets over the past decade or so, but they should be already ahead of the curve. They should be starting to make these, bite-sized acquisitions where they're able to pick up $1.5 billion of free cash flow at $300 million market cap, you know what I mean? And drive earnings on per share basis. Regarding the gold price, miners, you use the average gold price of every period, right, to model your profits over a quarter for each mining company. So the fact that, gold's wiggling around, staying up here, your average cost keeps increasing and increasing and increasing over the previous quarter. And as long as this happens, the miners are going to be printing profits over the next quarter or so. There's only a few banks, a lot of Canadian banks. I don't even know if any US banks cover the gold miners, but they value stuff at like $2,500 an ounce gold, $2,200 an ounce gold. And it drives me crazy to see the price of gold go higher and these analysts come out with upgrades. It's like it just because they raise their gold price, so their target's higher. It's like the only thing that we have is nobody knows where the gold price is going to be in a month from now, tomorrow, a year from now, 10 years from now. All we have is the current gold price. And if you use the current gold price to model these companies' profits, it's off the charts.
So with Newmont, you had the tweet about $3,300 gold. What does your model say Newmont is worth per share at a $3,300 gold price?
$90.
$90. Okay.
Yeah, $90. It's undervalued by about 45% right here. Yeah.
All right.
Yeah.
Yeah, that makes sense. Okay. So let's talk a little bit more about your golden portfolio. So I don't want you to give away all the secrets, but if you could tease it for us, tell us maybe one or two of the stocks in there and how do you come up with this portfolio?
Yeah, so I've got a few products. The first one was it's called the GP, the Golden Portfolio. It's a royalty-based product, right? Because if you plot all the miners versus the price of gold, the majority of them underperform the price of gold. You'd be better off buying gold itself, much better off buying gold itself than investing in a lot of the major gold stocks. But if you plot the royalties up against the gold price, the majority of royalties blow away the gold price. Royalties are the best way to play gold. Why? Because they fix costs, right? They negotiate contracts for that NSR. 20 years ago, when the price of gold was $200 an ounce, now it's at $2,000. All that increase is sheer profits that are dropped right to their shareholder bottom line. These companies are managed by 4 or 5 employees. They're worth billions in value. You get a CEO, you get a GO, you can even outsource the GO, you get a lawyer and a financial guy. You can run a royalty company. They're extremely well diversified, right? A royalty company's got 200, 300 different royalties on hundreds of projects around the world. All they need are 1 or 2 to go right. The rest of them could fail. And then, any 1 or 2 to go right, they could hit a home run, and that drives the increased profits on a per share basis versus the miners, right? Say you get a mid-tier miner that's got 1 or 2 mines. One of those mines goes down, the stock is done. I've been doing, I did the research and I'm like, what if you just owned a royalty portfolio since 2007 when Franco came out? I'm like, oh my God, you'd be up like 16,000% right now. So I built a royalty portfolio, and one of my favorites was Orogen Royalties, right? Orogen owns a 1% NSR on Silicon Merlin, owned by AngloGold. That's in Nevada. And AngloGold is a big company, so they were reporting drilling results like deep in their MD&A, and I was able to find them. And this started a few years ago, and I was like, holy shit, this already contains 3 million ounces of gold, and then it's already increased to 16.3 million ounces of gold. And then they came out with a little economic study that shows the mine's going to produce about 1 million ounces of gold a year, and in year 2 they're going to do 2 million ounces of gold. This is the largest gold mine in the world. Orogen owns a 1% NSR. It's worth a lot of money. It's worth the 1% NSR alone is worth 250 mil. And then Orogen just got taken out. Another benefit of the royalty industry, the big fish always eat the small fish. There's always ongoing consolidation. Whenever a smaller royalty has a crown jewel asset, like Silicon Merlin, they always get bought out. And Orogen got bought out by Triple Flag yesterday for 300 mil because they're going to spin off their Ermitano assets, so it's worth another 50 mil. Yeah, royalties, they're like watching paint dry, but it's 24 karat gold paint, right? It's not very exciting, but they do very well. So, if you're not the type of person to watch, the charts every single day, every single tick, like just buy the royalties and forget about them. Come back in 10 years and they're going to be worth a lot of money. My other products is GP 10X, smaller explorers and developers that because I'm focused on finding value in the troughs of the Lassonde curve, right? That's why we were talking about before, you get good drilling results, right? Then they need to prove them out and build their reserve. And there's value created all along the way. Trades off, creating another trough as they get financed. And then once they get financed and start building out and de-risking, market cap EV should match NAV at first production. That's that second chart. So I've got 30 companies in there that are smaller explorers and developers and miners that are underpriced in there, and that's where you get your biggest bang for the buck. But when the market tops out, the royalties perform much better because their costs are fixed. The miners, get smoked when the gold price goes down. And then, I've got my GPIV, which contains like my 4 of my top selections, and Orogen was in it. The GPIV is my introductory product. It's only 189. It's up like 300% over the past 2 years. Like it blows, like nothing's even close. Because I'm, like I said before, I'm longer term. Like I can sit through these wiggles, like the fact that the price of gold's down a little bit. I'm not trying to call a top, like based on asset flow. I know we have a long way to go, and I also know we have a long way to go because the companies in my GPIV and in my 10X, they're trading for 30% of fair value. They're trading for 20% of fair value. Like when this cycle peaks, they're going to be trading for more than NAV fair value, and that's where I'll become cautious, and I'll let everyone know at that point. But we're in like the second or third inning right here of a 9-inning ball game.
Yeah, I like that second or third inning at a 9-inning ball game. And I appreciate your conviction, because a lot of people will see the gold price move from 2,500 to 3,500 and say, that's it, I'm taking my profits, I'm taking the victory lap. But you're able, through your analysis, to see that this is a much bigger cycle. And for the gold mining sector, it's still very early, because actually you could argue that 2024 was still a bear market year for the sector. So how could we be at the top in April of the first good year?
Yeah, exactly. And then, doing the fundamental analysis, it's like, would you trade $3 for $15? Yeah, like all day, when I got to trade $20 for $15, and I'm like, no, that's stupid. I don't want to do that. But, and there's another company in my portfolio. It's trading for like 3% of NAV. It's got one of the largest gold deposits in the world. It's in the DRC, but Trump, like one of my tweets was, every day is like Christmas for gold investors with Trump, right? Like every day you wake up and something good's happening. Trump just made gold a critical mineral, right? Along with copper and, antimony. And what was it? The Stibnite project. Which company owns that?
Perpetua.
Yeah,
in Idaho.
Perpetua. And that just got fast tracked, right?
Yep.
On the list of like 10 projects that's going to be fast tracked. So that they're streamlining mining production. And then, with Trump, obviously there's a trade war going on with China, but Trump's going into Panama, right? He's trying to take back the Panama Canal from Panama and China. He's probably going to do it. And you know what else happened in Panama? First Quantum, Panama shut down Cobre Panama, which was First Quantum's largest mine. It's one of the biggest copper mines in the world, and it was 30% of Franco's profits. So Franco took a hit a couple of years ago, but Trump's going to bring this all back online. Why? Because it's good for the economy. It's good for profits. It's good for, everyone. And then Trump's getting involved in the DRC. One of their what's his name, Eric Prince, who was the founder of Blackwater, was already over there negotiating a contract for military security in exchange for minerals. So, the DRC with the U.S. military support could be a, favorable mining jurisdiction. And then, like Mark Bristow has been operating Kibali in the DRC without an issue for 20 years. Why? Because he takes care of all stakeholders. He takes care of the government. He takes care of the people. Everyone shares equally in the profits, and there's no problems. It's all about money, and I follow the money and I follow the profits. And what it's telling me right now is that we're early in this cycle.
I want to ask you one more question, and then we'll wrap it up. I think we'll definitely have more conversations in the future. This is a very rich topic that I think we can continue to unpack over the next couple of years. But final question, more of a portfolio construction question. So just I'll give you a setup. So I'm 45. So 45-year-old man with income, let's say between 100 and 250,000 a year, and I want to set up a gold stock portfolio. So I want to allocate a certain portion of my savings. Let's just come up with a number of $50,000, and I'm going to allocate this to gold mining stocks. How would you construct this portfolio? How many stocks would you put in there, and sort of like what's the max amount you would put into each company?
Ugh.
Tough question, huh?
Yeah. I don't know. 5%. Let me make this easy for you. Buy Franco. Franco's the king of the mining industry. You just buy Franco, right? And to
So
buy.
you wouldn't buy Newmont or Agnico
No.
or no?
No. Buy Franco. Franco's outperformed consistently over every single quarter. It's the king of the mining, king of the gold industry. It's the best way to invest in gold, as it says in the presentation, and their results speak for themselves. But, I don't know. You got to look at your own investment allocation. 5% gold, 10%, gold sector. But one of the most important things is, if you get involved with, some of the explorers and developers and smaller royalties, you need to stay diversified. And then what you do, what's most important is you need to hang on to your winners, right? Because over time, your winners will start out at 2% of your portfolio. They'll grow to 20% of your portfolio, and the losers will tail off. So you're sticking with the winners, and that drives your portfolio performance. Whether you're invested in gold or tech or healthcare or whatever, like 90% of your portfolio return comes from 5% of your investments. Like the majority of them aren't going to do well, but all you need are one or two to like go through the roof, and your portfolio is going to do great. And then another thing regarding, portfolio in the sector is, there's investors out there that search for the most highly leveraged names. Like, Eric Sprott's one of those guys. It's a lot of silver in there. It's a lot of smaller silver companies. They underperform 98% of the time. But that 1% of the time when silver rips and, the market goes crazy, these stocks will go up 2x, 3x, 4x. But you know how long those rallies last for? They only last for like a day or two, right? The gold price in 1980, it went out $300 in like 2 days, I invest for like the 99% of the time. I try to find the miners that are profitable over the vast majority of days. I'm not interested in leverage long shots trying to time the market, because the strongly profitable companies, they issue dividends, they buy back shares, they're able to drive shareholder value. These highly leveraged companies, when the price of gold and silver go up, you know what they do? They use the opportunity to dump more shares on shareholders, and the stock goes right back to where it started from. So I'm more interested in like accretive growth versus huge spikes and dumps afterwards. But yeah, I don't know, 5%, 10%. Franco's the best one. And then the majors are so undervalued right here. They represent a great opportunity, but the institutional investors start with the majors, and then the money flows in the developers and explorers. And they say there's no fever like gold fever, right? Like when people really start freaking out, like massive bull markets in the 70s and stuff like that. We haven't seen any of that yet. So with the developers and some of the explorers, you're able to buy them at 20% of what they're worth, and we haven't even seen the speculative run up yet because the money hasn't even entered the majors. And institutional investors will come, whether they like gold or not. They'll be attracted by the value, and they're attracted by the performance, because the S&P has done nothing over the past year, a couple of years, whereas gold stocks are up 50, 60, 80%. So they chase performance, and they're going to be coming. And I believe Newmont's earnings tonight are going to set it off.
All right, I'm gonna summarize the conversation. Buy Franco. Newmont's worth $90 a share, and stick with your winners. Buy more of the winners and cut your losers. Thank you, Garrett.
There you go.
It's a great conversation.
Thanks, Robert.
Thank you.